Welcome back to the Peterson Institute for International Economics. I'm Monica de Bolle, Senior Fellow here at the Institute, and it's my pleasure to introduce our speakers today. Maurice Obstfeld, who's our C. Fred Bergstein Senior Fellow. He's been associated with the Peterson Institute since February 2019. Warwick McKibbin, who's a distinguished professor of economics and public policy and director of the Center for Applied Macroeconomic Analysis in the Crawford School of Public Policy at the Australian National University. He also joined the Peterson Institute for International Economics as a non-resident senior fellow in 2023. Markus Brunnermeier, who's a non-resident senior fellow here at the Peterson Institute since February 2020, and is the Edward S. Sanford Professor of Economics Department at Princeton University. And finally, my boss, Adam Posen, who's the president of the Institute as well. So welcome, everybody, and thank you for coming. If I may, I will ask Maurice Obstfeld to please come up to the podium. Thank you.
Okay, good afternoon. Welcome to Peterson, everyone. We could spend the whole hour talking about the contradictions of US policy. So I'm just going to sort of list some key goals here. I'll leave it for you to discuss afterwards, the ways in which these are largely or partially incompatible. But there are a lot of asks from the world to rebalance US trade through trade deals, big tax cuts financed by tariff revenues, to attract inward greenfield FDI to build manufacturing capacity, rebalancing US foreign security commitments, containing China, maintaining the dollar's global role. These have all been put forward at one time or another, but they don't fit together easily, and trade-offs are inevitable. What do you do when you're faced with harsh trade-offs between different goals? Well, you could negotiate with allies, reach out to the world, look for multilateral cooperation. That is not the approach that the current US administration is taking. It is taking the approach of economic coercion. And the vision, I believe, and it's been enunciated by several allies of this view, is to create a kind of a co-prosperity sphere in which partners receive certain benefits and avoid certain sanctions, and they facilitate US objectives. This is really reminiscent of German and Japanese arrangements on the way to World War II. And the scheme has several potential elements. To set exchange rates at desirable levels, desirable for the US, that is. And this is what I take to be the main meaning of the talk about a Mar-a-Lago Accord. To erect barriers against China and Chinese content, to isolate China economically. To ask allies to help finance US deficits by buying long-dated treasury securities, to ask allies to potentially steer FDI toward the US, to support the US diplomatically, and finally, perhaps even to pay tribute. And this is reminiscent of the Chinese tributary system before the end of the 19th century. A lot of this is driven by various narratives of victimization, which drive the goals and the methods being used, and the conviction that these methods are indeed necessary and justified. One strand of this is that trade deficits are always and everywhere evidence of unfair trade treatment by partners. A narrative that the world has exploited the convenience of using dollars. The US has provided this great public good to the world, and the US takes advantage of this without giving anything in return. foreign allies have freeloaded on US military protection. Again, I'm not saying that all of these are completely without merit, but when you put them together, it is a kind of astounding array of grievances. In this story, China is the singular and unmitigated villain, but it's not the only villain. And as President Trump said on Liberation Day, our country has been looted, pillaged, raped, and plundered by nations near and far, both friends and foes alike. One other element of victimization I didn't list, but I think is important, is the idea that migrants into the US are taking advantage of the US as well. I would argue that the US has derived considerable benefits from the post-war multilateral system and from post-war multilateral security arrangements, which, among other things, have discouraged nuclear proliferation. But these benefits are largely ignored in this discussion. And besides, much of the economic analysis is flawed. Here at Peterson, we find that our comparative advantage is in economic analysis. And one could go through a lot of these complaints. I just want to talk for a second about one of them, which is the idea that global dominance of the dollar drives the US current account deficit and thereby impoverishes the US of treasure and jobs. In fact, this is a myth. In the chart here, you can see the very large gross inflows and outflows from the US, many dollar denominated, versus the current account balance. And there's just a very tenuous connection. The world can accumulate dollars not only by selling the US goods, but by selling the US assets. Particular concern attaches to the level of international reserves. It's held that foreign central banks have an increasing need for reserves. If they keep accumulating these through US current account deficits, the system becomes inherently unstable. But the fact of the matter is that the great reserve accumulation that we saw up until around 2010, 2011, 2012 has really come to an end. And even in nominal terms, on various measures, the world's holding of dollar reserves have been flat, which means relative to global GDP, they've declined considerably. So this is a very unconvincing explanation for ongoing US deficits. Now, if we look back in recent history to precedents, I'm not talking about the interwar period, there's one partial precedent here, which is 1971, the Nixon-Connolly Nixon shock. But it's very different from now for a number of reasons. First of all, Nixon took two very decisive actions. He went off gold, and he also imposed a 10% surcharge on dutiable imports to the US. And he had a very clear goal, a very clear ask, which was to, and a realistic one, to actually get foreign trade partners to revalue their currencies within the Bretton Woods system. Nonetheless, the aftermath was disruptive. The Bretton Woods system collapsed. We had a decade of very high inflation, and we can debate how much was related to the Nixon shock and how much would have happened anyway, but we don't remember the 70s that fondly in terms of economic performance. I think looking at the overall picture, I would have said a year ago with most analysts that because of the very strong network externalities and the dollar's dominant position, its global role was very safe. After all, there was, and I think is, no currency that is a likely alternative as a global currency. But I think now in this new environment, countries will want to protect themselves from US policy volatility and the US policy reach that the dollar affords. And if you look at the foundations of US currency primacy, all of them seem to be becoming weaker, if not disintegrating. Fiscal probity has been under pressure for a long time, but I think we're likely to move to a new level of pressures. Fed independence, everyone's watched the news of the last few days. Government functionality in the US is being degraded in ways that we are only starting to understand and that will unfold over time. The global security reach of the US is shrinking. The US is pulling back from its traditional role in promoting multilateral global security. The trade openness of the US is going to shrink. That's a factor. The rule of law and the courts is critical to how foreign investors view the United States. Those are under pressure. I think financial openness will inevitably come under pressure in various ways. One way is through breakdowns in international regulatory cooperation. We haven't seen much yet, but we can anticipate that the process of in the Basel Committee and the Financial Stability Board will not be smooth. Noises have been made about asking more for the privilege of swap lines, and if dollar swap lines are not available, it will lead to much less funding denomination in dollars, another source of fragmentation. And I also think that the developing cross-border payments platforms built on blockchains and stablecoins will require cooperation and oversight if they're going to operate efficiently and reliably, and how that would come about in negotiations with the US is questionable when the US is pushing a sort of Wild West in the crypto sphere. I think ultimately a country's national values are projected abroad. How it behaves internationally reflects national values, and there's a big regime change in national values clearly underway. No one currency can replace the dollar, as I said. I think that's still true, absent further reforms in foreign markets. But I think we could see regional zones centered on the dollar, the RMB, the euro, the yen. And how will this happen? I would argue that, as Ernest Hemingway said about bankruptcy, it'll happen gradually and then suddenly.
I seem to have Markus. There we are. Yep, thank you very much for coming today, and thank you very much to the Peterson Institute for inviting me to become a non-resident senior fellow and supporting this research here on an ongoing basis. I want to talk a little bit about the links between the tariffs we've seen, particularly since April 2nd, and what we expect might happen to the US dollar. And I should mention that this is an ongoing project at Peterson with Marcus Nolan and my colleague Jeffrey Schutram, based in Australia. So what I want to touch on in the 10 minutes is understand a bit more of what we expect for the US dollar to do when the US imposes uniform tariffs. Modelling the US tariff policy is very complex because every day it's different. So we've sort of picked a point in time and we're basing the analysis on that point in time. As it turns out, it's not just uniform tariffs. We're going to look at actually April the 2nd, the liberation tariffs. We want to also think about, well, if countries respond and retaliate to those changes in tariffs, does that have another differential impact on the US dollar? And the third issue is something which is very much discussed at the moment, is what does this do to risk? So it's not just the question of changing prices of tariffs in the US economy and US goods in other economies. Perception of risk has obviously been moving quite substantially. And so the model framework we're using would sort of look at whether or not what we observed particularly in the bond market in the US, can be explained by shifts in risk premia. And all this will be brought together in a forthcoming PIIE working paper. We just have to stop iterating on which tariffs we're going to use. But I think we're converging, given what we heard yesterday from Besant. So the model we use, and I won't go into detail, it's well documented. You can find it at the Peterson website. You can find it at the website gcube.com. The main features of this model is it's a hybrid of a conventional DSG type macro model and a sectoral computable general equilibrium model. What's key about the characteristics of this model is it integrates the financial linkages between countries with the real economy linkages between countries, but also brings in the production networks within countries and across countries. It's a global model. In reality, the US is at 24% of the world, 14% of trade. So we're talking about tariff wars. We're talking about 14% of the world trading system taking on 86%, which sounds like an unfair battle, but nonetheless, that's what the US is doing. We capture the G20 economies, plus we close the world with the rest of regional groupings. The key sectors that we worry about is energy, mining, agriculture, two types of manufacturing and services. So what the model does is it models the behaviour of households, firms and governments and central banks. And in a very conventional economic macro as well as microeconomic framework, we can ask scenario questions. There was a session here, excellent session this morning on central bank frameworks. This model is one that's used in central banks around the world, governments, hedge funds more recently, and it gives you an insight into what-if questions. So what we want to do then is we want to try and quantify some of the things we've been observing since the beginning of April. We're going to impose the Liberation Day tariffs of April the 2nd, and it's very important that we assume that people believe these will be lasting forever, more than a week, but forever. And we're not going to deal with the Chinese-US retaliation because we can't actually solve 165% tariffs in our model. I doubt you can actually solve that in the real world. So we're still struggling with that, but I think they will be disappearing before we get to the final draft. We then secondly ask what happens if other countries retaliate with equivalent tariffs. That's actually not what has happened. We have seen retaliation from China. We haven't seen retaliation from other countries. We have a threat of retaliation from Europe. So it's very complex. Expectations are very important, and we're sort of taking a particular point in time to tie down those expectations. The third point is what if this causes an increase in 100 basis points in the risk of holding US assets? So what if all of a sudden people perceive, as Maurice just mentioned, there's an unhinging of the US as the centre of the global financial system? We're taking away the risk-free asset, the UST bill. What if that unhinges to the point where to hold a UST bill, you need an extra 100 basis points to cover the risk? And we're just, as I say, taking a snapshot, and we're not dealing with the subsequent US-China trade war. So what I want to show you is, we solve the model out. We then say, let's do 3 different scenarios. And what I'm showing you is the impact on the US dollar in effective terms of those 3 different scenarios. So take the US tariff. This orange line says that when announced, the US tariff for the particular scale of tariffs and the asymmetries in the tariffs from April 2nd, you expect the US dollar to appreciate by 10% and to stay relatively appreciated. Where does that come from? Well, the US, once you levy a tariff on imports, the US importers need less foreign currency to buy goods because there'll be a big fall in the demand for imports. That means that therefore the dollar value of the dollar currency will appreciate. This is very conventional from international trade and from standard macroeconomics. You expect an appreciation. What if the world retaliates? Well, that's what the blue line has. It's got the US tariff plus retaliation. And so what if the rest of the world retaliates? They put tariffs on US products, then this exchange rate effect will be washed away because of the countervailing fact that the rest of the world is actually bigger than the US. And so the US dollar marginally depreciates by about 4%. And so when you add those two together, you can see why the US dollar may not have appreciated as much in April 2nd as it did in previous bilateral tariffs, because there was retaliation on April 2nd, or at least a threat. Now, the risk increase is the third point. So it's not additive. It's just, what if people lose confidence in the US economy as the centre of the global financial system? What if they need an extra 100 basis points to hold US assets? What that means is that the financial economy is going to start to arbitrage very quickly. People will start selling US assets, pulling their money out of the country. That'll depreciate the exchange rate, and that will then lead to changes in the real economy. And ultimately, if you're going to have a permanent increase in risk in the US of 100 basis points, the real economy has to generate a return on capital of 100 basis points more than it did before, which means you have to shrink the capital stock across the economy, different amounts in different sectors, depending on capital intensity. But ultimately, the economy has to shrink. The less productive capital has to be destroyed, and you have to get a higher real return on capital that matches the financial arbitrage that's going on in the financial markets. So that's the story here. So a change in financial risk actually has long-term real implications. So if you wanted to add the 100 basis points risk increase to the retaliation scenario, you could see that the US dollar could easily fall by 15% on announcement of tariffs with retaliation and a loss of confidence. So again, you can add these together. What does it do to the yield curve? Well, I've not put the yield curve here, I've put the 10-year bond rate. And so you can see you'd expect the 10-year bond rate with the US tariff, the orange line, to fall around 75 basis points. Why is that? Well, you expect it to slow down the US economy, which it does in this framework, which means that interest rates will fall, and you'd expect that bond prices would go up. If you get retaliation, the global economic slowdown is even bigger, and it mirrors into the US economy, which makes the US economic slowdown bigger. So you get a bigger fall of around 130 basis points. What if you have an increase in risk? Well, you're selling all the assets in the US economy. You're selling equities, you're selling anything financial, including treasury bills. And so therefore the price of those treasury bills goes down, the 10-year bond rates go down, the 10-year bond prices go down, and so the yield curve actually steepens. So here's a case where the yield curve is moving in the bond market and the equity markets are moving in the same direction, which you don't normally see. You normally see T-bill interest rates go down when equity markets fall. And so we can generate quite easily this sort of movement in the bond market because people are now losing confidence in the real economy and in the financial sector. And again, you can add the bond market effects to either of the tariff scenarios to get an idea of what might happen in bond markets. Why we pick 100 basis points? The reason is because it's within the ballpark. It's similar to what we're seeing in terms of recent movements in bond prices, but also because we have a model, we can actually put in the tariff and ask the question, what has to happen in the bond market to make the exchange rate not appreciate by 10%? And you get somewhere between 25 and 100 basis points as just a side calculation. What happens to the real economy? And again, these are all percent deviations in GDP relative to what would be the case. So this says that if you do the US tariffs as of the 2nd of April, US economy in 2026 will be over 1% smaller than it would have been. If there's retaliation, then you're going to have the US economy 2.25% smaller than it would have been. And if you have the risk premium shock as well, that leads to a contraction of the US economy. So you can add the risk premium shock to either of the two tariff scenarios, and you get a significant economic slowdown in the real economy as a result of the tariff. The final point from this chart to point out is that all of these policies lead to a permanent reduction in the size of the US economy at each point in the future. Why is that? Because they all reduce the return to capital, which means that you end up with a lower capital stock, less investment, and either directly or indirectly a loss of global investment around the world. So what are the final, this is coming to the end now, if you add them together, and again, you can see a lot more of this at the Peterson website. If you look at US tariffs, if you just, the change in the exchange rate you expect in the first year is around 9%. If you have retaliation, you get a depreciation of the dollar, not an appreciation. And if you add on the risk premium, you can get a depreciation of around 15% in the US dollar when you have the US tariffs with retaliation and a loss of confidence in the bond market. The bond prices could either go down or go up. If we had a larger risk premium, you'd find the yield curve would steepen even more. And the cumulative changes in GDP, which I'm just adding up in 2025 prices, the change in GDP over the 4 years of this administration, it's about $800 billion wiped out of the US economy just from the US tariffs. It double when the world retaliates, and then another $800 billion if we get an increase in risk. Higher risk, higher volatility destroys economic activity, and that's the risk you take when you have uncertain economic policies. And I'll stop there, and you can find all the documentation plus the equations and everything at the GQ website and at the Peterson Institute. Thank you.
Thanks a lot. Thanks to the Peterson Institute for giving me this opportunity to present here. I will talk about the dollar, the safe asset, and exorbitant privileges in plural, and a permanent trade deficit. But let me start with the geopolitical shift we are observing at the moment. So we started in a world order where we had very much focus on multilateralism, a rule-based framework, global framework, and everything was underpinned by mutual interdependencies. So we depended on each other. We were actually vulnerable to each other. We were not resilient against shocks. So we had choke points against each other, and global value change just in time, and everything made us dependent on each other. And that was the foundation to have a multilateral system, because we couldn't really individually, without any cost imposing on us and spillbacks on us, get out of that. But we're moving to a different world where everything is, instead of multilateral, is bilateral. It's not rule-based, it's transactional. And smaller countries is about what sphere of influence they're falling under. So rather than having a framework, we have coercion and uncertainty from this bargaining coming constantly. And the focus is now not on being mutually interdependent, but to have a national resilience. And just in case is a new motto instead of just in time. And there's a power shift away from smaller countries to bigger countries and bigger blocks. And even within blocks, there will be the smaller countries will have less influence, because you have to have enough weight in order to be powerful to bargain enough. And the smaller countries have to essentially decide which sphere of influence they fall under. Now, all the countries, especially smaller countries, they will try to hedge. Everybody is trying to hedge this risk, this new uncertainty. And the question is how to best hedge. There's the risk approach of saying, okay, I just diversify. I have to find some arrangement with all of them a little bit, but don't rely on one partner anymore. And then there's the resilience approach where saying I cannot really commit in the long run to something. I also have to be flexible. I have to have a plan B where I can readjust and re-optimize very easily. And that's from a geopolitical aspect, but also from a financial aspect. And typically how you get some hedges is to hold some safe asset. And the safe asset was typically the US Treasury. And the question is, and it came up already earlier, how will the situation look like once we move to that? But let me step back. So what is the safe asset? It's in terms of currency, it was US dollar. It was also a reserve currency if it's held by central banks and foreign governments, but more generally, a safe asset is for the whole financial system and also for individuals to hold a safe asset. And it is US Treasury in a sense. And typically, a safe asset is like a good friend. It's around when you need it. A friend in need is a friend indeed. So what's very important is for a safe asset, when you need it, you can sell it at a good, valuable price. There's no huge transaction costs. There's no asymmetric information, no default risk on it. There's no coercion that you suddenly have to hold it for 50 years rather than being able to sell it tomorrow when you face a shock. And the safe asset is also related to the safe asset tautology. It's safe because it's perceived to be safe. So it's a coordination. We have to believe and all coordinate on some belief, oh, this is the safe asset we treat as safe, and that creates additional liquidity and makes the asset then safe. And this was typically, or the most liquid and most global safe asset was the US Treasury. And when you look at the value of the safe asset, it has two components. So of course, it's the present value of cash flows. That's the future interest payment you get from the US Treasuries. That might not be so high, but you also get some service flow, because you can actually, when you need it, you get some service out of this. And through retrading, you can overcome some financial frictions. So we might not be able to insure each other very perfectly, but we both can hold a US Treasury. And if you face a negative shock, you sell US Treasury to me. And this way we can expose through retrading, reinsure each other. And this was actually a service flow the US Treasury gave us. And the service flow is especially valuable in times of crisis, in times when the risk is very, very high. Then actually it appreciates in value because it gives you more service flow. Because when there's a lot of risk in the system, that's when you need these safe assets. Through retrading, we can actually hedge this idiosyncratic risk. And we can also hedge aggregate risk, because in times of crisis, it appreciates in value. It has this negative cap M beta. So the beta is negative. So what you get from that is that the cash flow yield is very low. So there's a so-called convenience yield on it. There's an interest rate differential. I'm happy to hold the safe asset, even though the interest rate I get from it is very low, because it gives me this service flow. And if you can issue this safe asset, not only do you have to pay a very low interest rate, you can actually potentially issue it all the time. You can roll it over. You never have to pay it back. Okay, so you just print your dollars or print your US treasuries without ever paying back. And in this sense, you can actually run a current account deficit forever. So if you have this privilege to issue this safe asset, you can actually run a current account deficit forever. You never have to balance it down the road. And if you look at the income statements in international, the US is fairly balanced on that. So you can actually run a trade deficit forever. It's no problem at all. Now, what are these exorbitant privileges? And that's already what I alluded to. There are some structural exorbitant privileges which are permanent, and some which are more go with the cycle, with the business cycle or financial crisis. So you get, first of all, you get this convenience yield. You have to pay a lower interest rate. That's reflected in the current account. That's the only privilege which is in the current account. Then you get this safe asset status on top of it, where you can print this public asset without having paying back to it. That's not reflected in the current account. It's a huge privilege you have, but it's not, if you measure it, it's not there. And then you have a third one. The third one is whenever you go in a crisis, in a global crisis, the US Treasury appreciates, and that means you can actually issue debt very, very cheaply for you and can run a stimulus program, while other countries cannot run a stimulus program when there's a global financial crisis. And that's a huge benefit, that you can actually, through fiscal stimulus, can actually overcome a global crisis much more easily than others can do. So this appreciation in bad times, there's capital inflow to the US where you can benefit from that. So all of these three privileges, I think, are very valuable to have. And of course, you know, if you look at the history of the US dollar and the dominance, the US worked very, very hard to build up this status, to have the safe asset status it enjoys. Now, of course, this also implies to some extent a stronger dollar, but you know, the US is not only selling goods and services, but it also sells the service flow from the US Treasury, these three types of service flows. And that's number 2 and number 3 are not reflected in the current account and not in the trade balance or anything. And that's why, you know, there's a distortion in the perception in that. Now, what is going on, the policy is going, what my friend Jean-Pierre Landau calls a global financial repression. So the administration wants to keep the US interest rate low. That's, you know, the interest rate differential. So you do convince or coerce others, foreigners, to buy more US treasuries, but to weaken the US dollar, to boost US exports and, you know, reindustrialize the United States. But essentially what you have to do is you have to convince foreigners to buy fewer risky assets like equity and so forth. But of course, it means that, you know, the cost of capital for US firms will go up as well. So it will be overall more costly for US firms to refinance themselves. And so that essentially leads to a higher equity premium down the road for that, if you want to go for that. Now, overall, I think all this uncertainty created, and I should say uncertainty is essentially the main driver what slows us down, is, and uncertainty in my view is a tax. Uncertainty is like a tax without any revenue. So whenever uncertainty goes up, you know, there will be a higher risk premium, but it's not that as a government saying, okay, I impose a tax and I get a tax revenue. With uncertainty, there's just somebody gets a high risk premium, but he's compensated for holding this risk, and he hates it essentially, and you have to compensate him for this risk premium. But there's uncertainty of this loss of safe asset status. So the safe asset can actually jump to some other asset, like in Europe to the German bond, or it has to some extent also a safe asset status, or Japanese government bonds, so it can jump to some crypto assets, or it can jump to some new design of a European safe bond. Or it can actually, we have no global safe asset anymore, then we cannot do this reinsurance trading anymore. We have to just bear the idiosyncratic risk. But overall, this will weaken the exchange rate. So on the one hand, you have a lower dollar. That's to some extent desired by the administration, but it also leads to a higher term spread. That's not desired. So actually, the long-term interest rate will, in particular, will go up. And What happens is if you look at the term spread, you can decompose the term spread in many different components. There's default risk and there's other components. But one component which really is now shining through is this loss of safe asset term spread. There's an additional risk spread because we might lose the safe asset status, and you have to pay for it. And that's costly for US government to pay for this additional interest rate. So what does it mean for the rest of the world if potentially the US Treasury is going away, or at least is shaky in a sense of losing the safe asset status? Should the rest of the world just say, okay, there might be a situation where the safe asset status is going away, and that will be much worse, or should the rest of the world try to build up their own safe assets? So should the Europeans develop these SPs or sovereign bond-backed securities? I don't have time to go into that. Or should the emerging economies also develop something as a safe asset, as an alternative, so we have a more multipolar world in this setting? So that's one of the ways to say, okay, how can we hedge the situation? Of course, the Chinese, and as Maury mentioned, you can't have really the renminbi as a safe asset because there are capital controls on it. So let me sum up. So we have to arrange with the political shift which is going on away from a rule-based multilateralism. There's the risk approach, diversify. Everybody will try to hedge and diversify. And of course, you also want to be more flexible to adjust to the new world. So nothing is long run anymore stable, and you can plan in the long run. Everybody will be just more flexible. There's 3 exorbitant privileges, and the current account can be actually negative forever as measured currently, because some privileges are not measured in the current account. The US will try to keep them, but they also want to weaken the dollar by coercion. And if you want to keep the safe asset, you have to keep the safe asset tradable. It has to be highly tradable. And that's not consistent by just forcing people to convert T-bills into 50-year treasuries. And the safe asset status, it could be that it just becomes a little bit shaky, but it's not in the long run going away. That's probably the most likely outcome. But it will be costly. You have to pay an extra risk premium, or it will be costly for the US government. You have to pay an extra risk premium. And as Warwick mentioned, it has this positive co-movement with the US exchange rate, the dollar, and the US stocks at the same time. Or it could be we move to a situation where there will be more global safe assets floating around, which the safe asset status is more shared and more global, or we lose a global safe asset altogether. The last one I think is very unlikely. And then the question is, how will all the rest of the world hedge this risk we are facing and potentially build up their own safe asset alternatives? Thanks a lot.
Thank you all for coming out. I was saying must be our combination of folks, because we don't usually get this good a crowd when there's no officials speaking. But this is, in a sense, the most important topic, or one of the most important topics of the day. And it is one that, frankly, the official sector cannot talk about. I do commend to you yesterday, Klaus Knot, chair of the FSB, gave a speech here at Peterson in which he did, to some degree, address some of these issues, to a surprising degree, in fact. But I would like to go, in my own remarks, a little bit deeper on one aspect of what Maury rose that I think is complementary to some of the things that all 3 of my colleagues have. I want to just start, though, by pointing out 2 things. First, I'm using the term, a couple of us are using the term, decentering the dollar. And the reason we choose this term is the dollar isn't going to go away as a reserve currency, and there doesn't have to be one reserve currency. And as Markus just pointed out, you can have more than one safe asset. The question is more, how central is the dollar? And that's where I think we're seeing the movement, a decentralization. The second point is decentering the dollar is about a step change. That it's very interesting to make the comparison to when Maury and our colleague Doug Irwin held the conference here on 50 years since the end of Bretton Woods. And we were joking about the fact, wow, Peterson Institute used to do a lot of work on exchange rates, and nowadays we don't tend to do that much work on exchange rates, because we generally were the people who said, not uniformly, but mostly, there's real reasons why the dollar is ubiquitous. But those real reasons are being eroded. And so let me focus on one of them, which is this channel from foreign policy implications for the role of the dollar. That this is something that often gets overlooked because it's interdisciplinary and because sometimes it's seen as loose, but actually there is solid research and historical evidence of a connection here. And so there's an additional negative feedback loop from the Trump administration's choices in foreign policy to the role of the dollar. In essence, there were two open secrets that helped explain why the dollar was dominant. The first is we always talked about what I called the least ugly contest, that there wasn't a good, viable alternative to play such a central role in the world economy, be it the yen, the Deutschmark, the euro, the renminbi, let alone cryptocurrencies. But the second was that the security regime, which was tied to the US, actually mattered. And I'll take you through some of this, but the point was, until now, you had a situation where there were limited deviations. So, 2008, the dollar went down in value quite a bit, but there were self-correcting forces. And essentially, and this is a different way of stating some of the things that Warwick and Markus said, even when the US caused problems, people would flow money into the US because on net it was seen as safer. Even if the US had problems, usually everybody else's problems were worse. And so what I'm worried about, and what I think we need to pay attention to, is that the Trump administration really is changing the underlying regime. And this reverses the sign of the capital flows when the US is the cause of the problem. It doesn't mean necessarily that there's huge capital outflows from the US, but it means that if we screw up, then there are relative advantages of safety or hedging in a way that people didn't perceive them before. And so this is why the attention that went over the last couple of weeks to the phenomenon of so-called EM-like behavior, where the exchange rate went down and the 10-year Treasury went up at the same time, as opposed to usually them moving in the same direction, is important. This co-movement doesn't prove anything, but if we are at the start of a regime change, you would see this co-movement. It's pretty much necessary. It's not sufficient, but it's a necessary initial indicator. So let me go back, and I'm going to quote an article of mine, which almost none of you have ever read, from 2008, called Why the Euro Will Not Rival the Dollar. And the basic point is there was always this missing mass, that the dollar was held and used far out of weight with its economic gravity, with its trade role, with anything financial. And in fact, as these factors would change over time, as the other economies would grow, there was very little variation in who pegged to the dollar or extent of reserves. These were very sticky. Now, again, you can say, well, it's network effects, and there certainly is that. But I would argue in these various quotes, I argued at the time that the main reason the euro, for example, wasn't going to approach the dollar status was because of the lack of security. So when you look around, you look at Taiwan or Saudi Arabia or Panama that were deciding to peg to the dollar, there was no obvious economic reason to do it, or at least not to diversify. When you look, therefore, I warned that the dollar's global role is vulnerable to foreign policy failures. And so I raised the possibility that some apparently disparate aspects of US global hegemony will tend to rise and fall together. And that's what I fear is happening now. Now, the brilliant Barry Eichengreen, who I'm proud to say is a member of the board of the Peterson Institute, and co-authors picked up on this a decade later. Barry very kindly cites me, and did a much more sophisticated econometric analysis of this. And here's a long quote from them, and it's similarly, they're talking about why these countries on an economic basis would not have as many dollars as they do. And this is a chart where they talk about the light gray is the predicted holdings you would have on an economic basis, and the middle gray is the adding on the security side. Barry just reissued through Vox EU an update on this if anybody wants to read it. But so let me try to make this more tangible for you rather than as a steady state analysis. So what has happened is we have a number of examples in recent post-war history where countries change their pegging, change the orientation of their reserves based on exogenous switches in national security arrangements. So in rough order, the CFA franc zone, which was the one set of developing countries that really were oriented away from the dollar, was developed by Gaullist France and was developed, let us say, with some military encouragement. In fact, where we saw countries go in and out, like Mali, Madagascar, and Mauritania at various times, they exited when they made security shifts, when they were pushing out the French, when they were linking with the Soviets, and so on. Germany's varying sense of threat related to EMU. That in 1967, there was the famous blessing letter in which Germany said, okay, you're our security guarantor. We will not make any major sales of dollars without telling you or asking permission. And even after the Nixon shock that Maury rightly referred to, they kept on holding dollars extremely until 1979. But then it was 1992, they started EMU in earnest, and that happened to be when the Soviet troops were being pulled out, or the post-Soviet troops, excuse me, were being pulled out of Germany. I was living in Berlin at the time, and I remember talking literally with Chancellor Kohl about this. Egypt famously had a disaster with the Aswan Dam thanks to Soviet engineering, and of course started to flip over to the US side and did its deals with Israel, and that was the point they switched from relying on rubles to dollars for their aid. Japan, of course, famously acquiesced more than anyone would have thought they would have in the Nixon shock in '71, the Plaza Accord of '85, might have had something to do with the fact that the US had the security guarantee and had US troops living in Japan. Very interesting example, when the ruble zone broke up, when the Soviet Union broke up, and some of you in this room may remember this, the IMF actually advised the members of the Commonwealth of Independent States to maintain the ruble zone a little while longer, at least, as a transition, because they didn't want to repeat what happened to Eastern Germany, that you would have a sudden currency shock. And in fact, our former colleague Anders Aslund wrote about this at the time. And what happened was the exact opposite of what you would have expected economically. The Baltics, who stood the most to lose from having their currencies suddenly appreciate in value, were the ones who chose most quickly to shed the tie to the ruble in Russia and look west. The Stans, forgive my referring to them that way, were the ones who had the most to gain from moving to a harder currency, and they were the ones who stuck with the ruble zone because, perhaps not voluntarily, they had less a chance to go to the west. And finally, I just want to remind people that it wasn't an accident that it was Denmark, Sweden, and the UK, when they were all members of the EU, who initially were the countries who chose not to join the Euro area, and they also happened to be the countries with the most independent military expenditures. Now again, you can say this comes from a common cause, a sense of national identity, but Jacob's wrong. So now let me go running the experiment in reverse. What happens if Europe suddenly becomes more attractive in the security sense as well as in the economic sense? So what I pointed out in 2008 was a narrow economic argument would suggest if you spend a lot of money on defense and if it goes with deficits and it goes with lower productivity, you might end up eroding your savings, but whereas spending on defense in a security context, it flips. It actually makes you more attractive as a place to tie to because then you can offer some security benefits to others. So now I'll cite Jacob favorably. Jacob Kierkegaard gave us a presentation a week ago on the future of EU defense spending. So imagine you have a Europe that, in addition to creating safe assets in greater quantity of the sort that Markus has long rightly advocated, is using some of those safe assets to create more of an independent defense shield and that can be extended to other countries or support other countries. That would make their currency more attractive. So let's go back to being somewhat empirical. If this is a switch point, or step down in the centrality of the dollar, what should we be looking for? And essentially, and this again is restating some of the things that Maury and Markus and Warwick said in slightly different terms. What's happening is the security guarantees and the economic guarantees and the financial guarantees all combined to make the insurance proposition offered by the US valuable. You're essentially now offering from the US higher premium for lower insurance. And so you will see more of a move to self-insurance and to alternative insurers. I think one thing we should continue to watch for is the narrowing of the gap in EU versus US defense spending. I think we want to, and Nori mentioned this, the rise of the digital euro. It was very interesting, not just in Klaas Knot's speech here yesterday, but in President Lagarde's remarks roughly 2 weeks ago, in which he explicitly spoke in strategic autonomy terms about the desire to have a payment system in Europe that could not be shut down or monitored by the US. We have potential for real divisions over between EU and US. I list some of them. The one that I would feature, which our colleagues Cecilia Malmström and Jacob Kierkegaard and Olivier Blanchard and others keep reminding us, is the Americans don't seem to get, or at least this government doesn't seem to get, how important Ukraine is to Europe. But additionally, they don't seem to get that Europe is going to choose to buy fewer American-made weapon systems, at least the advanced complicated ones, than they would have in the past. And this will, of course, also be a flashpoint between US and EU in a mercantilist sense, given the Trump administration's goals. I think, as Maury mentioned, there's issues of capital inflows. I would particularly feature, pardon me, the issue of the Fed swap lines. This is something where it is totally in the US self-interest to have swap lines available. Certainly, if Chair Powell or any responsible Federal Reserve official was asked about it, they'd say they still function as normal. But ultimately, this is something that the US Treasury and the US Executive can constrain, or the US Congress can constrain. And this would be a kind of thing that, that up till now was not transactional bilateral in the sense, or only in very limited circumstances. I don't want to be absolutist about this. But if the Trump administration gives hints that they would like the Fed to be much more transactional or conditional or politically conditional in availability of the swap lines, that would be a huge shift. And then, of course, going back to things the Peterson Institute used to work on but stopped and will now restart, what happens with the Asian Monetary Fund, the Chiang Mai Initiative, various alternative swap lines? This may be a transition point. For all the reasons that Warwick and Markus set out, this may be a very costly transition point for the US and for the world, but at a minimum, I would like people to be aware that the security channel probably reinforces the likelihood of this being a transition point to decenter the dollar. Thank you very much.
Well, thank you for this extremely important discussions. We'll now open to a broader, I will use my prerogative as a moderator to ask the first question, and then afterwards there's going to be a roving mic towards the front of the room, and for those sitting in the middle and the back of the room, please line up at the microphone on the back, and I will let you know how much time we're going to have for questions. We do not have much time left. So I'd like to push you all. Thank you all for your presentations, and I'd like to push you a little bit further on this decentralization of the dollar. So last week we had a book launch here at the Peterson Institute. It's my book, The New Economic Nationalism. And in The New Economic Nationalism, we looked at a bunch of country cases of various points in time, countries that adopted economic nationalist policies. So policies that include industrial policy, protectionism, amongst a host of other measures. And the main finding there is countries that used and abused these policies not only tended to have very bad economic outcomes, but notably there was a distrust or damage to the trust in policymaking in these countries. And of course, trust is the backbone of currencies. So with that in mind, I'd like to ask you, in light of the new economic nationalism that we see in the US, characterized by not just industrial policy and protectionism, but immigration restrictions and a repudiation of international agreements and international institutions, that of course erodes trust. How do we then look at the dollar in that context? Anyone may start. Thank you.
I'll start by just first off saying the book, The New Economic Nationalism by Monica de Bolle, Jeremy Cohen-Seton, and Mahdi Sarsanbayev, which the Institute was proud to publish last week, is a good book. And what's important, as I tried to say, though I couldn't be there for the launch, but I said online in multiple places, is that the book has relevance for the Trump and other world of today, but is entirely based on past research, past events. I mean, I don't mean past research in the sense old research. I mean, in a sense, research based on past data. And I think I would just say that as what Monica just listed, I think resonates very strongly with what Maury just listed, and to some degree the spirit of all of us here, that one should think about some of these changes in conjunction with each other. That it is, if not coherent economically in the straight up analytical sense, as Maury points out, it is something of a coherent program, a coherent ideology that we've seen before. And so in that sense, I see the dollar, again, with very specific things, but I see that as part of the same overall potential regime shift.
Thank you. Maury.
Yeah, I mean, just generally, this issue of trust, is so critical. And, if you think about how we get a lot of flack these days for talking about, the rule-based international order. But the rules are important because if there are rules and you can trust that others will follow the rules, that kind of facilitates a good equilibrium. And if reputation is important and people try to preserve reputations, that preserves a good equilibrium. And we know from everything economics teaches us, about central banking and other spheres that when you move to a highly discretionary equilibrium, you can get suboptimal outcomes. And my sense of where US policy is going now is that the US would like a free hand to act with complete discretion in every sphere at every time. We look at the administration negotiating, 80 trade deals. After the world has witnessed, the renegotiation of USMCA and other trade deals, and then they're totally thrown overboard. How much trust can there be? So I think this is a very bad place for the global economy to be, and the problem with trust is that you can destroy it really quickly. You can't rebuild it very quickly, and the destruction in the last 100 days has been epic.
Thank you, Maury.
If I could just add to what Maurice said, one of the big casualties, I think, is global public goods. The provision of global public goods would be severely damaged when you lose trust. And we're going through a period of an energy transition, climate challenges. We're going through a whole range of global problems that need cooperation. And without trust, you won't get very adequate cooperation. And this is, I think, a very dangerous transition.
Yeah, very much agree with this. So the way I see it is like if everybody does their own self-insurance, of course it's way more costly. So if you have a cooperative trust arrangement, a global framework with rules, as Maury and Warwick point out, then it's of course much more efficient, and we can spend the resources more efficiently, insure each other in an efficient way. If we move to a world where everybody tries to be, self-insured, be resilient on a national level, and have redundancies and extra buffers in order to do so, that actually makes the whole world, makes the whole system to run much more higher expense ratios, and that's less efficient. So you will see also then the welfare come down.
Okay, just to say, since our audience has kindly stuck with us, I
Yeah.
exercise my executive excessive discretion to extend the question period for you to get some audience questions.
Thank you. Okay, so we will open up to the audience. So as I said, there's a roving mic up here in the front, and for those who are in the middle or the back, please line up at the microphone at the back. And do state your name, your affiliation, and as Adam always says, do make your comment into a question, and do make that comment a question, actually, succinct. Thank you. I can't believe that after this discussion, there are no questions.
Thank you very much. So one of the things that this administration claims is that they have leverage. Dan Volberg, they have leverage because the U.S. is the consumer of last resort. That's been a line that's been repeated several times. And I'm sort of curious how you think about that, and how does that relate to sort of the outlook from here? And then maybe a second question is, to the extent that the U.S. share of the global economy and global trade has continued to decline over decades, does it make sense for the U.S. to be rethinking the global system in that maybe there were some benefits, but there are also some costs? Thank you.
Thank you. Let me take one more. Ted.
Ted Truman, Vasavar Romani Center for Business and Government, Harvard. So this was a very excellent, in my view, but a very depressing set of presentations. So I'd like to ask you whether there's anything, since Maurice started out with a whole list of incompatible objectives, maybe he would like to point to some objectives that he would, by themselves, support, or other people on the panel might want to support.
Thank you, Ted. Please.
I'll give you one by way of answering both questions, which would be some rebalancing in China. The administration has pushed the idea that China should favor consumption more as a way of reducing global imbalances. I think that's something that some of us at Peterson, and when I was at the fund, we've called for that for a long time. It would benefit the world. It would benefit the Chinese people. And in terms of the second question, if China became a bigger consumer market, it would help undercut some of this bargaining power that the U.S. claims as being the consumer of last resort. China could also become a more major consumer, and that would be really good not only for global equilibrium, but for strengthening everyone's bargaining position in the game that we're playing now.
I could just respond to the first question. It is important that the US's role in the world has been falling over time. The centre of gravity of economic growth is shifting to Asia, and has been doing that for decades. Geopolitics hasn't been shifting in that direction sufficiently quickly. So you have this disjuncture between what's happening in the economy versus the geopolitical strengths in the world. So I can see this is an opportunity for starting to reconfigure the international institutions to be more reflective of what's actually happening in the economy. And I think what we've seen is two forces have hit each other, the geopolitics and the economics, and this was inevitable. It's just happening more quickly than a lot of people would have hoped or expected.
Thank you.
Yeah, some brief remarks. So essentially, the US, I think, has a lot of leverage. And of course, you should use your leverage to get the benefit out of it, but you should not at the same time destroy your privileges. I think that's, I don't fully understand why would you destroy these privileges. And then in terms of benefits and costs, so I haven't seen any cost and benefit, but I would say the US benefited from the international order more than the costs were. But of course, one has to calibrate a model for that. But my intuition is that they benefited a lot. And you can see this also in the technological space. I think there's a lot of advancements going on, and the US can benefit having a global market on that space and dominating the tech space in this dimension as well. And this might be also undermined. So there are huge amounts of costs for the US moving away from the global order. The whole world benefited for the last 80 years. And of course, one of the aspects, of course, that China has to focus more on consumption and less on investments and reshape that. That's, of course, was already pointed out for the last 15 years. And to some extent that the administration tries to achieve that through some shocks. And it leads to a reshaping of the Chinese policy. That's actually a good thing to have. Just to answer the last question.
Do we have time for one more, Adam? Yeah? Okay, so please. So there's a mic here, and please go ahead with your question in the back.
Yeah, Valerie Mercer-Blackman, World Bank. I had a question about an endless current account deficit, Markus, that you mentioned. I just wanted to clarify whether that was because they had the currency and how that could happen, and also related a little bit to maybe some of the things Maurice said, which is a fiscal deficit. Is there any, I mean, talk about what could happen to bond prices and things like that, but what would be the situation if the deficit does get worse? Is that going to be the end, and how? Just run us through that. That would be great. Thanks.
Thank you.
Yeah, Mark Schieritz from the Zeit, German newspaper. Just getting back to the point Adam made, I was wondering if there is some sort of free lunch situation arising, in the sense that if you increase defense spending, stealing away some of the exorbitant privilege from the US, moving into Europe, and then, of course, making it easier to finance that defense spending.
Perhaps I focus on the first question. So what happens in order to run a permanent deficit, a current account deficit, what's necessary that you can actually issue new treasury bills, and you can constantly issue it without having actually paying it back, because you're able to roll it over. And for this, what's really important is that the real interest rate you pay is below the growth rate, the global growth rate. And the real interest rate you pay is actually very low if you have the safe asset feature, because everybody tries to save for precautionary reasons in your safe asset. So that makes it the real interest rate you have to pay very low. If you have on top of it this negative CAPM beta, so the risk premium on this is actually then negative, so that depresses the real interest rate further. So there are many reasons why the real interest rate, the cash flows you have to pay as the US government, is very, very low, and pushes it below the growth rate of the global economy, which typically is the case. And in such a world, you can actually run this scheme, and you can have a deficit for a long time. And then on top of it, we don't capture this in our measurements, because we don't capture the current account, that you can run these schemes and all this. It's not part of the current account, and the trade deficit is not captured there. So there's an element of mismeasurement there. So if you were to measure these elements, then the whole current account would be much more balanced.
Thank you. Some places, if you go out for lunch, they say if you buy a sandwich, you get a free bag of chips. I think that's the way to think of it. It's not a free lunch, Mark, but it is a additional bonus you get from making this investment. And so whatever the net costs and benefits are, there's an additional benefit people tend to overlook. That providing security in the traditional sense makes your currency more attractive, both in the sense of making you arguably seem relatively safer, but also more of a safe haven. Which of course goes back to Dan's previous question, that when you have this litany of things that we reportedly hear Trump administration officials showing up at Tokyo or Berlin or Brussels or wherever, or Seoul, saying, you owe us N trillion because we've been defending you. Well, there have been some benefits even in the direct cash sense the U.S. has accrued through providing that security umbrella, even if it didn't literally charge our allies for that. Although, of course, with basing, they do.
Could I just address the fiscal for a second? First of all, I'll say there's no such thing as free chips. Or free fiscal deficits. The Congressional Budget Office is projecting high deficits and high and growing levels of public debt for the U.S. as far out as the eye can see. And that's on the basis of the current law assumption that some of the tax cuts in the 2027 Act will be reversed. Congress is going to extend those cuts, and so everything is going to blow up further. If that happens in an environment of lower confidence in the dollar, borrowing will be more expensive for the Treasury, not necessarily because of default fears, but because of fears of fiscal dominance. And you know, as we progress and Chair Powell's term ends, if it has not ended prematurely, the opportunities for that will become even greater. So I think it is a major concern. And of course, that will not help the current account deficit at all. It will move it in the wrong direction.
If I could just throw an advertisement in for a Peterson Institute publication that came out yesterday. Our estimates of the revenue from the tariffs under different scenarios is nothing like $6 trillion. The administration estimates seem to be based on how many imports there are times the change in the tariff rate. Whereas if you endogenize tax collections, responsive importers, responsive exporters, responsive other countries, how it feeds through the corporate balance sheets, how it feeds through household balance sheets, you can get down to about $790 billion for a 20% uniform tariff. So to think that you can use a very narrow base like imports to finance the blowout in the US fiscal deficit is extremely optimistic mathematics.
Thank you. Well, with that, unfortunately, we do need to adjourn this very, very exciting and, of course, timely and important discussion. I will end just by paraphrasing Hemingway once again, because I can't resist it. The way you, and it is a paraphrase, so the way you find out whether you can trust someone or a currency is by trusting them. I'll let you figure out the rest. Thank you very much.